What is making the Fed be so aggressive in raising interest rates? Let's dig into what we think is actually happening with inflation and what the Fed could do about it. The Fed raising interest rates 75 basis points, indicating that they're going to raise it again, another 50 to 75 basis points. If you remember, we had Chris Leonard on the show, author of this book, Lords of Easy Money, in February of 2022. He chronicles the history of the Fed over the past 100 years, right? The creation of the Fed in its current incarnation, what happened in 08, quantitative easing, right? All these topics. It's like, Chris, what do you think? You think 4%, once if the Fed gets a 4% interest, do you think that starts to have some cataclysmic impact on the economy? Because that's where it was back in 06. And then, we had the crash of 08. He said, no, actually, if it gets to 2%, you're going to see fireworks in a bad way. And we're already at 1.5, gang. This interview was February 24th, 2022. That's 4 months ago, almost to the day. Just 4 months ago, we were saying, the Fed at that time had signaled they could raise 6 or 7 times this calendar year. And we were saying, well, maybe they could get to 2% by the end of the year. And what Chris was saying is if that happens, 2%, you're going to see all kinds of things go really, really bad. Basically, the way I think about it is when the cost of capital increases as interest rates rise, the ability for investors to make riskier bets, basically, for example, investing in tech startups, that becomes much riskier, right? Because your cost of capital increases, you have other less risky investments that are going to pay you, just interest, other forms of debt. To me, what does this say? If the Fed, they're trying to instill a sense of confidence in everyone, but if you actually look at their actions these past few months, to me, it says exactly the opposite, because they completely missed the ball on labeling inflation as being transitory. You can check the tape on this show. We've been calling it for over a year, saying that inflation was absolutely not transitory. Had a bunch of data points, still do have a bunch of data points that still show that inflation has not been quelled and is not transitory. And so what I think the Fed is realizing is that because they missed this for so long, this thing has really started to spiral out of control. They know, although they've been very bad at their job, the Fed, they're not idiots. They understand that, for example, when you raise interest rates, to actually see the true impact of that interest rate increase, it takes many months, if not quarters, for markets to respond, right? There are real estate deals that are in motion, right? That, are getting pot, working on a construction loan, got a construction loan, working on permanent financing, right? There are mid to large size businesses that have debt, which they need to renew that debt. And, even $100 million size business, when they need to refinance their long-term debt, right? That doesn't happen all the time, right? That happens, they might have multiple tranches of debt, but the point is, that happens over a period of time. Could be in a few years, could be in a few months, could be in a few quarters, but right, the business decisions that are being made when interest rates go from 0 to 50 basis points to 1%, to now 1.5%, possibly to 2 or 2.25 is what the Fed has signaled they're going to do in the next FOMC meeting here in July. You are not seeing even 60-70% of the actual impact that the raises they've already done will have on the economy. Does that make sense? Right? Like even just going from 75 basis points to 1.5, which they just did, you're not going to see the full impact of that raise, that 75 basis points raise for maybe, let's say, a year from now, right? By the time all the different ramifications and subsequent decisions that roll back on that are truly manifested in the economy. Okay, so why do I bring that up? Because if they're continuing to raise at such a aggressive pace, that means that they're continuing to understand how high inflation is. And they have not fully grasped how high it is. That's the only thing that can make sense to me when you look at these reports, right? Annual inflation rate is 8.6% for the 12 months ended May 2022. Hey, you got to understand that those readings, they have a bunch of exceptions. They're not including a bunch of things, right? So there's a bunch of adjustments. Like our WeWork videos we did, community adjusted EBITDA, and that BS term. They're fudging the numbers on inflation, and they admit it. They say, well, we got to exclude this and we got to exclude that. This 8.6% to me is saying that in reality, it's probably at least double this, right? You're probably actually seeing over 20% inflation, just massive inflation. If the Fed is continuing to raise at this rate, right? Like if they are needing to be so aggressive, that means putting the genie back in the bottle, the genie being hyperinflation, that genie is so far out of the bottle that they will it's pretty much, in my mind, a certainty that they are going to crash the economy. No one wants to say that we're in a recession. We're in a recession. Everyone wants to say, oh, it looks like there's a recession on the horizon. We're in a recession. Okay. But despite all of that, right, the Fed's main objective over the decades has been to keep inflation in check. And man, we called it on the show, been calling it on the show for over a year. They missed the ball on it last year. This thing has now just gotten completely out of control. So what am I hearing in the market? What I'm hearing in the market is that we have yet to really see the impact of inflation. Inflation is still coming, right? And here's how I know, because we do a lot of work in B2B distribution. And what my B2B distributor sources are telling me is, so they buy from manufacturers, right? So B2B distribution buys from manufacturers. Then B2B distributors sell to a business customer, which then sells to an end consumer. They could be selling it to a contractor who is then buying materials to go build a house or a building. They could be selling it to a restaurant or a retail store that is then going to sell it to the consumer, right? So from the point when the B2B distributor buys that product from the manufacturer to the point where it actually then trickles all the way down to the end consumer is many months, maybe 6 months, some cases shorter, some cases longer. But right, so what they're saying is they're manufacturers. This is across the board, many different verticals of B2B distribution. What they're saying is, I'm seeing manufacturers, and this is weeks. I'm talking about over just the past few weeks, right? So before and after the Fed now raised 75 basis points, what am I seeing? What I'm seeing is they're saying manufacturers are raising prices. The number of price increases that they're seeing manufacturers provide has only continued to increase, right? So manufacturers aren't adjusting prices down, okay? So if they're doing a price change, price is going up. Distributors are saying, hey, the volume of price changes that we're seeing from manufacturers is only increasing, despite the Fed raising interest rates, okay? A, and then B, that the size of the price increase is also increasing, right? Like a supplier might actually raise their price by over 20%. Unheard of, right? Usually few percentage points, maybe 5%, be big. No, that you're seeing like 20% jumps. Not all from all the suppliers, right? But you're just seeing the volume of price increases increasing. And then you're seeing the variability, the size of the increase also hitting astronomical records. The supplier increases definitely trickle down to the end consumer. The B2B distributor then needs to raise prices. Then the business customer that the distributor sells to needs to raise prices down to the end consumer, right? So there's kind of multiple price increases after the manufacturer sells to the distributor. That's the only way I can try to make sense of how the Fed continues to raise rates at such an aggressive clip, having to know that the economy is not stable. When you print this amount of money, you exacerbate the situation, right? You don't make it more stable. You've made it more unstable. If you like this video, go check out our videos from last year where we talk about what was happening with inflation, and we got it right 110%. Plus Chris Leonard's interview, Lords of Easy Money author. But also those videos from last year is really where we were saying, hey, the Fed is wrong. Inflation is not transitory. Fortunately, we were right.